Let's start off with the buying of the mortgage-backed securities. Now, we did see a knee-jerk reaction. Yeah. Mortgage rates did go down. Our Diana said it went down just about 0.25%. Obviously, that's real relief for a lot of people, at least in the near term. How sustainable is that, in your opinion, when we see the purchases of MBSs reducing mortgages in the market?
I think, in general, people think that rates are going to go down to 5%. And the last time we had such a large scale of mortgage purchases was during the pandemic. The Fed was buying $25 billion a month. And so when we look at $200 billion, that's just a lot of money to pour into the mortgage market. And spreads have gone on a 30-year versus a 10-year, 30-year mortgage versus a 10-year treasury has been over 200 basis points. The historical average is 100 bips. So if we get the buying to bring it down to historical averages, we're looking at a 5% interest rate, which is a lot of savings for Americans.
Okay, 5% interest rate. Now, that's interesting. I think that gets every, look at you where you're nodding. I think a lot of people start nodding when you have a 5% interest rate, but we know how many people have an interest rate under 4%. Also, isn't affordability really, when it comes to down payment, the option? People actually getting the money together, not only for the down payment, but also having credit scores where they can get one of these reasonable mortgages. You and I were just looking, if you look on Mortgage News Daily, mortgages for a 30-year fix are at 6.06, but there's two other big hurdles: having the credit score, having the right debt-to-income ratio, 3 actually, and having the down payment.
I think the biggest thing that consumers can do is, if they're looking to upgrade their house and move from an existing house to a better house, refinance your existing house. On Better.com, we're seeing consumers who refinance increase their credit score by about 31 points and bring down their monthly payments by about $1,000 a month. That's real savings. That attacks the debt-to-income ratio. You're right. Average American family has a 40% debt-to-income ratio. That means on $100,000 annual income, they're paying $40,000 in debt payments. You need to bring that number down. You need to get your credit score up. And then, obviously, that savings allows you to accumulate a down payment so that you can upgrade a home.
Okay. You say about, I think, half of Americans, if mortgage rates keep going down, could be what you call in the money for a refinance. So explain that idea. What's in the money for a refinance, and how low do the rates need to go?
I think the traditional idea was it was 50 basis points of rate reduction. I think it's very different. Most people in America today are living month to month. So I think if you can save $100 a month, you should do a refinance. And if rates go down to 5%, more than half of American families with a mortgage today will be able to save $100 a month or more. And on top of that, with our new AI debt advisor on Better.com, it will calculate all the other debts that you want to pay off: your credit cards, your auto loans, your installment loans. It'll do all the math for you in all the permutations. And there you can save as much as $2,000 a month. That's what people are doing.
Got to talk to you about the 50-year mortgage. Now, I think everybody who owns a home has talked about it, just how much interest you would end up paying in a 50-year mortgage. However, it does have the potential to make getting into a house more affordable. How are you viewing the potential of a 50-year mortgage?
I love the idea of
You love it?
I love it for a 50-year mortgage for first-time home buyers. You know what's better than having to pay interest a little longer? Not having to pay rent and having it all go away. So I would much rather pay a little bit more interest over a period of time, get a 50-year mortgage, get into the home ownership ladder, be able to actually afford a home, raise my family there, not have to move, not have to have the rent go up every year as it has for the past 5 years, and not having to throw that money away on rent. That's what's great.
We got to go very quickly. The idea of corporations being able to buy single-family homes, do you think that drives up the prices of homes? Does it drive up the prices of rent? How do you view it?
I think it has an impact on starter homes. I think the presence of companies being able to buy homes directly from home builders, which is some of what's been happening in the single-family rental space, where people have been building houses to rent. I think if that's not available, I think it opens up the availability of starter homes for first-time home buyers, and I think that's a very good thing.